Something significant has shifted in the financial landscape. And if you've been paying attention, you felt it, not in your emotions, but in the data. Over the past several weeks, the precious metals complex, gold and silver combined, has experienced a correction that has erased approximately $2.5 trillion in aggregate value across global holdings. Simultaneously, broader equity markets have shed roughly $1 trillion. If you hold these assets, you've already noticed. If you don't, you might wonder whether now is the moment to reassess your position. But here's what matters most. This kind of movement is neither unprecedented nor, by itself, a signal to act on impulse. I want to walk through this situation with the clarity it deserves, not the sensationalism it often receives. In the next 25 minutes, we're going to examine what has actually happened, why it happened, what it reveals about the underlying forces shaping our financial world, and most importantly, how a disciplined investor should think about it. My aim is not to tell you what to do with your money. My aim is to help you understand the forces at work so that whatever decision you make comes from knowledge, not emotion. Let's start by being precise about what we've observed. The price of gold, which had been trading near or above historical peaks, has experienced a meaningful pullback. Silver has followed suit, though with greater volatility. These aren't small corrections. For those holding these assets, it feels real. And it is real in the sense that prices have genuinely declined. But real and permanent are not the same thing, and that's where many people get confused. When any asset class experiences a sharp decline, the first human instinct is to ask, is this the end? But that question reveals a fundamental misunderstanding of how markets actually work. Markets don't move in straight lines. They breathe. They oscillate. Every significant rise contains within it the probability of a significant pullback, and every pullback contains within it the possibility of continued decline or renewed strength. What we're witnessing is not a surprise to those who have studied market history. It's not even unusual. What it is, however, is an opportunity, though not the kind most people reflexively imagine. To understand why this moment carries weight, we need to step back and examine the conditions that preceded the recent rally in precious metals in the first place. For several years, the world experienced unprecedented monetary and fiscal stimulus. Central banks expanded their balance sheets to historic levels. Governments spent at rates not seen since wartime. The effect was predictable. The supply of money in the system expanded dramatically, while the supply of goods and services could not keep pace. What followed was inflation, real inflation, not the statistical measures that sometimes obscure it, but genuine erosion of purchasing power that ordinary people could feel in their grocery bills, their rent, their fuel costs. In response, central banks raised interest rates with a speed and magnitude that startled many observers. Now, here's where the narrative shifts. Gold and silver are among the few assets that perform well when both inflation is rising and currency is being debased. They also perform well when there's uncertainty and when faith in institutions is questioned. For several years, all of these conditions existed simultaneously. The metals rallied strongly, and that was rational. But something has changed in the data, and that change is what we're now seeing reflected in prices. This is not speculation or wishful thinking on the part of central banks. The evidence is visible across multiple measures. Energy prices, which spiked dramatically, have moderated. Supply chains, which were chaotic, have stabilized. Wage price dynamics, which were threatening to become unmoored, have shown signs of settling. None of this erases what happened. Inflation still sits above historical averages and above where central banks say they want it to be, but the trajectory has shifted. This matters enormously. When rates are rising, investors can earn reasonable returns on safe assets like bonds and money market funds. As that opportunity begins to disappear, or as people begin to believe it's disappearing, one of the major opportunity costs of holding non-yielding assets like precious metals diminishes. Fewer people will accept a 0% return from gold if they can only get a 1% return on short-term bonds, but many more will hold gold if they can only get a 1% return elsewhere. The market is attempting to price in this shift, and that's what we're seeing reflected in the recent correction. A weaker dollar is traditionally supportive of precious metals prices, because when your home currency declines in value, alternative stores of value become more attractive. But in the very short term, market participants are repositioning, and that repositioning creates volatility. This is crucial to understand. This is not a surge of risk appetite that's pushing investors away from safe haven assets like gold and silver. Rather, this is a moment of broader reassessment where investors are questioning valuations across all asset classes. In these moments, gold and silver sometimes decline along with risk assets, not because they've become less desirable in the long term, but because investors need cash, or because leverage positions are being unwound, or because sentiment has shifted sharply. Here's what happens in the minds of most people during a pullback. They assume one of two things. Either they believe the asset they held was always wrong and they should never have bought it, or they believe this is a temporary dip and they should buy more immediately, expecting a quick rebound. Both of these reactions miss the more subtle and important reality. The thesis for owning precious metals in the current era is not that they will go up every year or even every several years. The thesis is that in a world of currency debasement, geopolitical instability, and unprecedented debt levels, precious metals serve as a form of insurance. Insurance is not an investment that pays you return. It's something you buy so that if a particular bad event occurs, you're protected. Now, when nothing bad has happened recently, insurance seems like a waste. But when something bad does happen, you're grateful you bought it. This is why examining the circumstances matters so much more than examining the price. Is inflation fully vanquished? No. Is the federal debt declining? No. It's accelerating. Is geopolitical tension reduced? No. It's elevated. Has faith in institutions recovered fully? No. Are central banks still devaluing currencies? Yes. Are they still holding record amounts of gold in their reserves? Yes. These facts have not changed. What has changed is the calendar and certain expectations about the immediate direction of rates and inflation. That's real, and it creates genuine trading dynamics. But it doesn't erase the underlying case for the asset. If you've studied the history of precious metals, you know that this has happened before, several times. Gold has experienced corrections of 30%, 40%, even greater, sometimes multiple times within a single decade. And yet, if you measure returns over longer periods, particularly periods when currency was being devalued, or when geopolitical events were unfolding, gold has served its historical purpose. This is not accidental. It's baked into how the asset behaves. It's uncorrelated with stocks and bonds during crisis periods, but it is correlated during periods of currency debasement. That means it will sometimes move differently than we expect, in ways that feel wrong or frustrating. The most important thing to understand is that these cycles are not random. They follow from the underlying dynamics of the financial system. When debt becomes extreme, central banks attempt to reduce it by inflating it away. When they do that, savers are punished through currency debasement, and they move toward alternative stores of value. When inflation accelerates beyond what's acceptable, central banks raise rates, and suddenly those safe alternatives become less attractive, and people reduce their holdings of insurance-like assets. Then, as inflation declines and debt pressures return, the cycle turns again. We're in one of these turning points. It's painful if you bought near the peak of the rally. It's confusing if you're trying to time the market. But it's entirely predictable and normal if you understand the cycles. Markets are driven by supply and demand, yes, but supply and demand are themselves driven by human psychology. And human psychology is remarkably predictable, even though it feels unpredictable in the moment. When an asset is rising, and has been rising for some time, people begin to believe that rise is permanent. They extrapolate recent trends into the future. They buy because everyone else is buying, not because they've conducted independent analysis. They believe this time is different. These are the moments when peaks form. Conversely, when an asset has declined and the decline has been steep, people begin to believe the decline will continue forever. They sell because everyone else is selling. They believe they should have gotten out sooner. They believe the thesis was always wrong. These are the moments when bottoms often form, though no one knows it at the time. You can protect yourself from being whipsawed by these psychological currents only by having a framework, a clear understanding of why you own something and what conditions would need to change for that reason to no longer apply. For precious metals, that framework might look like this. I own gold and silver as insurance against currency debasement, geopolitical risk, and extreme debt levels. These conditions persist. Therefore, I will maintain my position through normal volatility. I will reassess only if there's evidence that these conditions are genuinely resolving, not just taking a temporary break. With a framework like that, you can weather the noise. If you already own gold and silver, let's be direct about what you should be thinking right now. First, take an honest inventory of why you bought. If you bought because you saw a YouTube video and someone was excited and you wanted to make a quick profit, this is a painful moment. That was never a solid foundation. But if you bought because you understand the structural issues in the global financial system, and you believe precious metals serve as insurance against those issues, then nothing fundamental has changed. Second, don't panic sell. Selling after a decline locks in a loss and takes you out of the position precisely when the risk-reward may be most favorable. Some of the best returns in any asset come in the 12 to 24 months following a significant correction. If you sell now, you'll miss them. Third, consider whether this is an opportunity to increase your position if you have dry powder available. I'm not saying you should lever up or go all in, but if you had been wanting to own precious metals and didn't yet have the capital, or if you wanted to own more, prices are now lower than they were. That's a straightforward fact. Whether you act on it should depend on your financial situation and your conviction. In the thesis, not on whether you think you can perfectly time a bottom. Fourth, examine the quality of what you own. If you own physical metal, you're in a good position. If you own ETFs or mining stocks, be aware that these can behave differently from the underlying commodities during periods of volatility or deleveraging. Fifth, maintain perspective on timeline. Precious metals are not a short-term trading vehicle if you're using them properly. They're a long-term insurance position. 1-year returns don't matter, 5-year and 10-year returns matter. And those returns will be determined by whether the thesis holds up, whether currency debasement, geopolitical risk, and debt pressures remain real factors in the world. The most important thing I want to tell you is this. If you're feeling regret right now, that feeling is normal and natural. Everyone has felt it. But regret is usually a signal that you didn't fully believe in the thesis in the first place. Use this moment to either recommit with genuine conviction or to reassess fundamentally. But don't use this moment to make an emotional decision you'll regret in 3 years. If you haven't yet accumulated precious metals, what does this correction mean for you? First, it means you don't have the bitter pill of recent losses. That's a genuine advantage in terms of emotional clarity. You can look at current prices without the anchoring effect of having bought higher. Second, it means this might be a more opportune entry point than it was 2 or 3 months ago, depending on your framework and your conviction. Prices are lower now. If you believe the thesis, if you believe currency debasement and debt pressures are real long-term forces, then lower prices are better for new entrants. But here's what matters more than price: understanding whether you should own precious metals at all. The case for ownership is straightforward. We live in a world where central banks are almost everywhere, pursuing policies of currency expansion and interest rates that are below real inflation. We live in a world where the ratio of debt to GDP in many nations has reached levels that are structurally unsustainable. We live in a world where geopolitical tensions are elevated and where confidence in institutions is questioned. In this world, holding some portion of your wealth in assets that are not simultaneously someone else's liability, assets that have been stores of value for thousands of years, makes sense. How much precious metals should you own? This is individual. Some financial advisors suggest 5% to 15% of a portfolio. Others suggest 20% to 30%. I won't tell you a number because it depends on your age, your time horizon, your other assets, and your risk tolerance. But the principle is sound. In a world of financial uncertainty and currency risk, some exposure to precious metals is prudent. What should you avoid? You should avoid buying all at once, near market peaks, with money you'll need in the next 2 or 3 years, or with leverage. You should avoid buying because you heard a podcast and got excited. You should avoid buying without understanding what you're buying and why. What should you do instead? You should develop a plan. You should decide what percentage of your portfolio makes sense to allocate to precious metals based on your personal situation. You should then acquire that position steadily over time, monthly purchases, quarterly purchases, whatever discipline you can maintain. This approach, called dollar cost averaging, eliminates the need to time the market. You buy some near highs and some near lows, and let your average cost ends up being reasonable. You should also educate yourself. Read about the history of precious metals in the financial system. Understand what they do and what they don't do. Understand the difference between physical ownership and paper ownership. Understand the tax implications in your jurisdiction. Then, once you've decided to own them, you should update your plan only when something fundamental about your situation or the macro situation has actually changed. Now, let me be very clear about what you should not do in moments like this, because there are several nearly irresistible temptations, and they're all destructive. Some investors, seeing prices fall, decide this is the moment to buy in margin, borrowing money to amplify their position. This is how people who should be winners end up as losers. Leverage magnifies both gains and losses. In a volatile asset during a correction, leverage is how you get forced to sell at the worst possible time. If you don't currently have leverage, don't add it. If you do, consider removing it. Precious metals are insurance, not a trading vehicle. You don't leverage your insurance policy. This is the psychological phenomenon where someone loses money and then feels compelled to make aggressive trades to make it back quickly. It rarely works. In fact, revenge trading is how small losses become large ones. If you're down and frustrated, the correct action is usually to do nothing, to step back, to wait, to let time work on your behalf. Prices decline. That's what they do sometimes. It doesn't mean the thesis is wrong. It means the thesis is being tested. If you're going to own precious metals, you have to be willing to own them through corrections. If you're not willing to do that, don't own them. But don't pretend you have conviction and then abandon it the first time there's pain. Some people see a correction and think, I'll sell here and buy back lower. This is tempting. It's also usually wrong. You have to catch both the sell and the buy. You have to do it multiple times. And you have to do it better than the collective wisdom of millions of other traders with more information than you. The odds are not in your favor. Buy and hold with a clear thesis. That's the approach that works. Right now, there are people on the internet shouting that gold is going to crash further. There are other people shouting that we're at a bottom and about to skyrocket. Both of these voices are confident and articulate. Neither of them actually knows the future. What you should do is gather information from multiple credible sources, think it through yourself, and then make decisions you feel comfortable with. Follow wisdom, not personalities. The internet provides you with endless information about precious metals prices, mining news, central bank policy, and so on. This information is useful only if you've developed a framework for interpreting it. Without that framework, you're just noise trading. Develop the framework first, then use information to refine it. But don't let information alone drive your decisions. If you're buying precious metals and you'll need that money for a house down payment in 6 months, you've made an error. Precious metals are for medium to long-term positioning, typically 5 years or longer. This time, Horizon gives you the ability to weather cycles without being forced to sell at inopportune times. There's an uncomfortable truth that most financial advice avoids. You cannot know the future. You cannot know whether inflation will accelerate again or continue to decline. You cannot know whether central banks will maintain restrictive policy or whether they'll pivot to easing sooner than expected. You cannot know whether geopolitical events will escalate or de-escalate. You cannot know the exact dates and magnitudes of market moves. What you can know is the long-term trends and the structural forces at work. You can know that debt levels are elevated. You can know that demographic trends in developed nations are challenging. You can know that central banks have been expanding currency supplies for years, and this tends to eventually pressure currencies. You can know that geopolitical tensions exist. And you can know that in environments like this, precious metals have historically served a protective function. But you cannot know whether that function will be needed over the next 6 months or the next 6 years. You cannot know whether the process will be smooth or chaotic. And you cannot know whether other factors will emerge that you haven't anticipated. This is why the emphasis on time horizon matters so much. If you own precious metals with a 5 to 10 year horizon and a genuine belief in the thesis, the specific price today is far less important than the overall positioning. Intermediate volatility simply doesn't matter much if you're not going to be forced to sell. Let me zoom out for a moment and discuss what this moment means in the context of the broader financial environment. For 3 decades, and particularly in the years since 2008, we've lived in an era of financial ease. Central banks kept interest rates low and expanded their balance sheets. Debt accumulated and accumulated. Asset prices of all kinds, stocks, real estate, bonds, commodities, reached historical peaks. The assumption, which became almost universally held, was that central banks would always be there to support the system, that there was no serious risk of a major disruption. The period from 2020 to 2022 put that assumption to a test. Suddenly, inflation became real and persistent. Central banks had to make a choice, allow inflation to run, or raise rates sharply and risk financial instability. They chose to raise rates sharply. This triggered a reassessment across all asset classes. We're now in a period where that reassessment is ongoing. Rates may have peaked, but they're still restrictive by historical standards. Inflation is declining, but remains elevated. Debt is still accumulating. Asset valuations are still elevated. And investor sentiment is bifurcated. Some people are convinced the crisis is coming. Others are convinced we'll muddle through. In periods like this, confusion is normal. Everyone is reassessing. Some money is fleeing risk assets. Some is looking for safety. Some is positioning for secular inflation. Some is betting on deflation. The result is volatility across the board, and that volatility is what we're experiencing right now. The question is, which forces will ultimately dominate? Will we enter a period of genuine financial stress and currency debasement where precious metals will be highly sought? Or will economic growth resume, inflation continue to decline, and the case for precious metals weaken? The honest answer is, we don't know yet. This is being determined in real time. But the trajectory of the data will tell us which direction we're heading, and it will do so with increasing clarity over the coming months and quarters. Here's a mental framework that will serve you better than any price prediction. Instead of asking, will gold be at X price in 6 months? A question you'll probably get wrong. Ask, instead, what is the probability of each major scenario, and how do my positions reflect those probabilities? In broad strokes, there are several scenarios. The economy slows slightly, inflation continues to decline, central banks eventually cut rates, and things largely return to normal. In this scenario, precious metals could underperform. Growth assets and bonds would both perform better. Probability estimate, moderate. We enter a period where inflation stays elevated, rates stay higher for longer, growth is below trend but not recessionary, and risk assets struggle but don't collapse. In this scenario, precious metals hold value but don't necessarily rally. They serve their insurance function without providing spectacular returns. Probability estimate, moderate to high. Growth falters sharply, unemployment rises, credit stress emerges, and the financial system comes under pressure. In this scenario, precious metals would likely rally significantly as a safe haven. Growth assets would suffer. Bonds might do well. Probability estimate, non-trivial but not base case. This is the worst scenario. Inflation remains elevated despite economic weakness. Central banks face an impossible choice, and confidence in currencies declines. In this scenario, precious metals would likely perform spectacularly. Probability estimate, not the base case, but an uncomfortable possibility. Now, how should you position? If you think scenario 1 is most likely, you might own 5% precious metals as insurance and keep most assets in growth and bonds. If you think scenarios 3 or 4 are serious possibilities, you might own 15-20% because the insurance is more valuable. There's no single right answer, but thinking in probabilities rather than certainties will keep you sane. The correction we're experiencing right now is partly because markets are repricing away the probability of scenarios 3 and 4 in the very near term. Inflation has declined enough that the urgency around currency debasement feels less acute. That's a legitimate shift in probability, and it's driving prices. But whether it's a temporary repricing or a fundamental change won't be clear until we get more data. I want to emphasize something that gets understated in financial advice. Your personal time horizon is perhaps the single biggest determinant of what you should own and how you should feel about short-term volatility. If you're 25 years old with no need to access your investments for 30 years, corrections in precious metals are almost irrelevant. You can buy steadily regardless of price, knowing that over your 30-year horizon, the fundamental case for precious metals, protection in a world of currency debasement is very likely to play out positively. You can ignore the noise entirely. If you're 65 and retiring in 2 years, precious metals should be a much smaller position because you need your capital to be stable. You simply cannot afford large drawdowns. In your case, precious metals might be 5% or less, real insurance, not a core holding. If you're 45 with a 10-year horizon until retirement, you're somewhere in the middle. You have time to recover from volatility, but not unlimited time. A 10-15% position in precious metals might make sense, paired with a longer-term buying plan that allows you to accumulate through cycles. The correction we're seeing right now will feel very different depending on where you sit on that spectrum. Recognize that your reaction to it should be modulated by your actual situation, not by headlines or social media commentary that might be coming from people with completely different time horizons. Let me be direct. The financial industry benefits when you're emotional. Fear and greed are profitable for people who trade against them. Newsletters and videos that are sensational get more views than those that are balanced. So the ecosystem is biased toward getting you to feel urgently and react quickly. The antidote is education. Not education about where you think gold will be in 3 months. That's speculation masquerading as education. But education about how the financial system works, about the history of precious metals, about cycles and trends, about the risks you're genuinely trying to insure against. When you understand these things, you become much harder to manipulate. You see a correction and you think, is this the beginning of something bigger or just a normal drawdown within a longer-term thesis? You see someone shouting about a crash coming and you think, maybe, but what do they actually know that I don't? You see prices rising and you don't feel the desperate fear of missing out because you have a plan and you're executing it. This is why I encourage you to allocate time, maybe an hour a week, maybe more if you're interested, to genuine financial education. Read historical accounts of how precious metals behaved during past crises. Read about the structure of the international monetary system. Read about debt cycles and currency debasement. Read about investor psychology and how it drives markets. This education will serve you far better than any price prediction or market call. As we wrap up this analysis, I want to return to the fundamentals, because that's where solid thinking always returns. The question you should be asking is not, should I panic? Or should I buy frantically right now? The question is, have the fundamental reasons for owning precious metals changed? Here's what has actually happened. Inflation has declined from peaks, and that's real. Interest rates may have peaked, and that's probably true. The dollar has weakened, and that's observable. These are all factors that were bullish for precious metals, and their moderation is a legitimate reason for a correction. But here's what has not happened. The federal debt has not been paid down. It's continuing to grow. The structural issue is not solved. The Federal Reserve is not calling for a return to sound money. Central banks worldwide are not abandoning their accumulation of gold reserves. Geopolitical tensions are not substantially reduced. The long-term perspective that central banks might need to devalue currencies again is not off the table. In fact, if we think about the likely trajectory over the coming decade, the probability that inflation will be a recurring problem, perhaps not every year, but on average, is quite high. The probability that debt will eventually need to be inflated away is quite high. The probability that certain geopolitical scenarios will unfold and create uncertainty is quite high. These are the fundamentals that drive long-term precious metals prices, and they have not changed in any meaningful way due to a price decline. So where does this leave you? Let me offer some clear, practical guidance. Take a breath. Look at your long-term thesis. If it's sound, corrections are part of the process. Maintain your position. If you have capital available and genuine conviction, consider this an opportunity to add. If you're uncertain about your thesis, use this moment to either recommit with clarity or to exit thoughtfully, but don't let emotion drive the decision. Start a systematic accumulation plan. Decide what percentage of your portfolio makes sense. Set up monthly or quarterly purchases. This approach removes the need to time the market and gives you psychological comfort that you're doing something disciplined. Expect volatility. That's part of owning precious metals. Stay informed, but don't let information become noise. Read serious analysis. Ignore social media hype. Think about your real situation, your age, your time horizon, your other assets, your risk tolerance. Then make decisions that align with your actual situation, not with what you think others think or what you wish were true. Precious metals provide insurance and diversification, but they don't provide yield. They'll sometimes underperform stocks and bonds. That's the cost of insurance. You don't resent your health insurance when you don't get sick. Don't resent your precious metals allocation when growth assets outperform. Inflation spiking again would be relevant. Central banks stopping their gold accumulation would be relevant. A genuine reduction in geopolitical tensions would be relevant. A monthly fluctuation in prices? Oh, not relevant. Ignore it. This is perhaps the most important thing I can tell you. Financial markets reward people who can think long-term and stay disciplined. They punish people who react to quarterly moves. Precious metals will eventually prove their value in a world of currency pressure and financial uncertainty. Whether that's 3 years or 10 years from now doesn't change the fundamental case. Here's an uncomfortable but crucial truth. Even having read this script and having developed a framework, you will not feel perfect certainty about your decisions. You will sometimes wonder whether you should have done something differently. That doubt is normal and healthy. It means you're thinking. It means you're not absolutely certain you're right, and that humility is protective. The goal is not to eliminate uncertainty. That's impossible. The goal is to make decisions that are rational given what you can know, to implement them consistently, and to be willing to update them only when genuine new information emerges. Will precious metals look like a brilliant investment in 10 years and you'll be glad you accumulated them? Probably yes, based on the structural forces at work. But you should be comfortable with the possibility that you'll be wrong, or partially wrong, or right, but at the wrong times. That's investing in the real world. Certainty is for people with incomplete information. The correction in precious metals and the decline in broader equity values that we're experiencing represent a moment of repricing. Risk assets are declining in value because certain assumptions about inflation and interest rates are being revised. This is not pleasant if you own these assets, but it's entirely normal. Every significant advance contains within it the seed of a correction. What matters now is not the direction of prices over the next few weeks. What matters is whether you can maintain discipline, whether you understand why you own what you own, and whether you're willing to think long term. The world we live in is one of elevated debt, currency pressures, and geopolitical complexity. These are not temporary conditions. They're structural. In this world, precious metals serve a purpose. They have served this purpose throughout human history. Will they serve it in your time horizon? That's something only time will tell. But the probability is sufficient that rational investors maintain meaningful exposure. If you already own precious metals, I encourage you to use this moment not as a moment to panic, but as a moment to reaffirm your conviction or to exit thoughtfully if you've lost faith. If you don't yet own them, I encourage you to think seriously about whether they make sense for your situation, and if they do, to begin a systematic accumulation plan. Above all, I encourage you to remain calm, to think clearly, and to remember that investing is a long-term activity. Corrections are not failures. They're opportunities to think more clearly about what you own and why. Use this one. Thank you for listening. Stay disciplined, stay informed. And remember, understanding the cycles and preparing accordingly will always serve you better than reacting to the noise.